Did you know that the richest 1% of people in the world own more wealth than the other 99% combined? It's a shocking statistic, isn't it? This stark reality of global wealth distribution is a sobering reminder of the widening gap between the rich and the poor. It's a world where the rich keep getting richer while the majority struggle to make ends meet. But why is there such a vast disparity? One significant factor is the lack of financial education. Many of us are taught to get a good education, find a secure job, and save for retirement. However, this traditional path rarely leads to wealth accumulation. Instead, it often leads to a paycheck-to-paycheck existence, burdened by debt and financial insecurity. Financial literacy, understanding how money works, is not typically taught in schools. And yet it's this knowledge that empowers individuals to make informed decisions about their money. It's the know-how that enables the wealthy to grow their fortune and the lack thereof that keeps the majority from breaking the cycle of financial struggle. The truth is, wealth isn't about luck or even just hard work. It's about understanding and effectively managing assets and liabilities, making smart investments, and leveraging opportunities. It's about knowing how to navigate the financial landscape to your advantage. This understanding is precisely what separates the wealthy 1% from the rest. They know how to make their money work for them, rather than working for their money. It's a shift in perspective, a different mindset that can transform one's financial destiny. These statistics are a wake-up call. It's time to level up your financial knowledge and start building wealth. And who better to learn from than Robert Kiyosaki, the author of Rich Dad, Poor Dad? He has dedicated his life to teaching others the principles of wealth building, principles that are often overlooked in traditional education. Kiyosaki's teachings offer a roadmap to financial freedom, a way to join the ranks of the wealthy 1%. It's time to take control of your financial future. The journey to wealth begins now. Robert Kiyosaki's first rule to getting rich is prioritizing assets over liabilities. So what does that mean? In the world of Kiyosaki, assets are things that put money in your pocket. They're your income-generating investments, like stocks that pay dividends or rental properties that provide a steady stream of rental income. On the other hand, liabilities are things that take money out of your pocket. They're your debts and ongoing expenses. A car loan, for instance, is a liability. Every month it drains money from your pocket to pay for something that's depreciating in value. The key to building wealth, according to Kiyosaki, is to focus on acquiring more assets and minimizing liabilities. It's about shifting your mindset from spending on liabilities like a new car or designer bag to investing in assets like a profitable business or income-generating property. So instead of buying that new car or designer bag, think about how you can invest in assets that will bring you income. Now that we know the importance of assets, let's delve deeper into what kind of assets you should acquire. The essence of wealth creation lies in the power of income-generating assets. These are assets that consistently put money into your pocket, creating a steady stream of income over time. Dividend-paying stocks are a prime example. These stocks consistently reward their investors with a portion of the company's earnings, providing a regular income stream. Another powerful income-generating asset is real estate. Rental properties, when managed well, can provide a stable and predictable cash flow each month. And let's not forget about businesses. A well-structured business that can run independently without your day-to-day involvement is a tremendous asset. It's like having a money-making machine that works for you round the clock. So invest wisely. Seek out these income-generating assets and let them do the heavy lifting. Remember, the goal isn't just to accumulate money, but to have your money work for you. It's not just about what you acquire, but also about your mindset. This is where the shift from consumption to an investment mindset comes into play. It's a game changer in the quest for financial freedom. When we talk about a consumption mindset, it's the one where you're constantly chasing the next big purchase. That shiny new gadget, the latest fashion trend, or even that luxury car you've been eyeing. It's a never-ending cycle. Now consider an investment mindset. Here the focus isn't on what you can buy next, but rather what you can invest in next. Instead of a new phone, perhaps you think about stocks. Instead of a designer handbag, you consider a rental property. The money you would have spent is now working for you, creating more wealth rather than depleting it. This shift in perspective is powerful. It enables you to make financial decisions that prioritize long-term wealth accumulation over short-term gratification. So, next time you're tempted to splurge on a luxury item, ask yourself if that money could be better spent on an investment. Work is not just about earning money, it's also about learning. This is a crucial perspective that Robert Kiyosaki emphasizes. He suggests that the true value of work lies not in the steady income it provides, but in the skills and knowledge it imparts. Imagine being a junior employee in a real estate firm, learning the ins and outs of property investment. This knowledge could someday help you make wise investment decisions, leading to a substantial passive income. Or consider working in a startup, where you gain first-hand experience in entrepreneurship, equipping you with the skills to launch your own venture in the future. These examples underscore Kiyosaki's point that while a job may offer a regular paycheck, the real wealth lies in the learning opportunities it provides. So don't just work for the paycheck. Work for the knowledge and skills that can help you earn more in the future. Taxes and corporations may sound boring, but understanding them can save you a lot of money. Let's delve into that. When you grasp tax laws, you can strategically plan your finances to minimize what you owe and maximize what you keep. For instance, certain investments or expenses might be tax deductible, effectively reducing your taxable income. Now, let's talk corporations. Establishing a legal entity like a corporation can provide tax advantages. Corporations can write off numerous expenses as business costs which individuals can't. Plus, they're taxed differently. While individuals are taxed on their total income, corporations are taxed on their profits, which is income after expenses. This difference can lead to substantial savings. So, the combination of understanding tax laws and utilizing corporate structures can be a powerful tool to maximize your income and investment opportunities. So, don't shy away from learning about taxes and corporations. It can be your secret weapon to wealth accumulation. Not all debts are created equal. There's good debt and there's bad debt. Let's clarify this. According to Robert Kiyosaki, bad debt is debt that takes money out of your pocket. This is typically consumer debt like credit cards or car loans, used to purchase things that depreciate in value over time. On the other hand, good debt is debt that puts money into your pocket. This could be a mortgage for a rental property, a business loan for an enterprise that generates profit, or a student loan for an education that leads to a higher-paying career. The key here is leveraging good debt to acquire assets that generate income or appreciate in value. For instance, taking a loan to invest in a rental property could turn into a steady stream of rental income, making it a good debt. So it's not about avoiding debt altogether. It's about understanding the difference between good and bad debt, and using it wisely to build wealth. Remember, it's not about avoiding debt altogether, but about using it wisely to build wealth. Putting all your eggs in one basket is risky, especially when it comes to income. Imagine you're a farmer with a chicken that lays golden eggs. If that chicken gets sick or stops laying eggs, you're left with nothing. The same principle applies to income. If you rely solely on one source, like a 9-to-5 job, you're at risk if that source dries up. So, how do you diversify your income streams? Think of earned, passive, and portfolio income. Earned income is what you make from your job or business. Passive income, on the other hand, comes from investments that require little to no daily effort, like rental income or royalties. Portfolio income is derived from investments like stocks, bonds, or mutual funds. By diversifying, you're not just relying on one chicken to lay golden eggs. You've got a whole flock working for you. So don't rely solely on your 9-to-5 job. Look for other ways to generate income and secure your financial future. Money that's just sitting in the bank is money wasted. Now this might be a bit of a shocker. Isn't saving money a good thing? Well, yes and no. Let's break it down. Picture this. You've tucked away a neat sum in your savings account. It feels safe, secure. But here's the kicker. While your money is lounging around, inflation is on the move. Inflation nibbles away at your purchasing power, and before you know it, your hard-earned savings are worth less than when you first banked them. Now let's flip the script. Robert Kiyosaki, the financial maestro himself, advises us to invest in assets that offer higher returns. Assets like stocks, real estate, or even a side business. These investments work tirelessly, pumping out returns and ultimately outpacing inflation. This way, your money isn't just idling around, it's hustling, it's multiplying, it's working for you, not against you. So don't let your money gather dust, put it to work and watch it grow. When it comes to investing, following the crowd is not always the best strategy. It's easy to get swept up in the latest trends, the hottest stocks, or the newest cryptocurrency. But remember, what's popular isn't always profitable. It's the financial equivalent of jumping on a bandwagon, and that bandwagon might be heading for a cliff. Instead of relying on hearsay or hype, do your own research, understand the market, evaluate the risk. Make informed decisions that align with your financial goals and your risk tolerance. Don't let peer pressure or fear of missing out drive your investment choices. Remember, the most successful investors, the Warren Buffetts and the Robert Kiyosakis of the world, they didn't accumulate wealth by following the herd. They blazed their own trail. They saw opportunities where others didn't. So don't be a sheep, be a wolf. Make your own path and create your own wealth. You are the average of the 5 people you spend the most time with. This gem of wisdom is often attributed to motivational speaker Jim Rohn, and it rings particularly true when it comes to your financial journey. Consider this. If you're surrounded by individuals who are financially savvy, who understand the importance of assets over liabilities, and who continually seek opportunities to grow their wealth, you're naturally going to be influenced by their mindset and actions. Their knowledge becomes your knowledge. Their success can pave the way for your success. Imagine having a friend who's a real estate mogul, another who's a stock market whiz, and another who's built a successful startup from scratch. The insights you would gain, the lessons you would learn, and the opportunities that could arise from these relationships would be priceless. It's not about using people for their knowledge, but rather, fostering mutually beneficial relationships where everyone grows together. So, choose your circle wisely. It can greatly influence your financial success. Knowledge is power, especially when it comes to investing. Without a clear understanding of the market, you're essentially playing a high-stakes game of chance. But with the right knowledge, you turn the tables in your favor. It's not enough to just know your product or service. You need to understand the wider market conditions, trends, and rules. Is this the right time to invest? Is the market on an upswing or a downturn? Are there regulatory changes on the horizon that could impact your investment? These are the kinds of questions you need to answer. Recognizing market cycles is also crucial. Markets rise and fall. Knowing when to buy, hold, and sell can make a huge difference in your returns. Timing is everything. So before you invest, do your homework. Understand the market and make informed decisions. In the world of investing, knowledge truly is the ultimate power tool. Let's recap what we've learned from Robert Kiyosaki's rules to getting rich. We began our journey examining the importance of prioritizing assets over liabilities. Remember, assets are the golden geese that keep laying those golden eggs in your pocket, while liabilities are the pesky foxes that keep snatching them away. Then, we dove into the concept of investing in income-generating assets. It's not enough just to save money, you've got to put it to work. Think rental properties, businesses, and investments that pay dividends. We also discussed the need to shift from a consumption to an investment mindset. It's about trading the pursuit of material possessions for building a portfolio of income-generating assets. Kiyosaki also emphasized the value of working to learn, rather than simply working for income. It's the skills, insights, and knowledge you acquire that can be leveraged for future entrepreneurial or investment ventures. Understanding taxes and corporations was another key point. Mastering the art of navigating tax laws and using legal structures like corporations can help minimize tax burdens and maximize income and investment opportunities. We learned about the distinction between good and bad debt. Good debt, according to Kiyosaki, is used to acquire assets that generate income or appreciate in value, while bad debt simply drains your resources. The importance of diversifying income streams was discussed. Relying solely on one income source can be risky, so consider earned, passive, and portfolio income for financial stability. We also examined the folly of keeping money idle. Saving money in a bank without investing it can lead to loss of purchasing power due to inflation. We cautioned against following the herd. Making financial decisions based on popular trends or peer pressure can lead to regret. Instead, conduct your own research, understand the market, and make informed decisions. Lastly, we talked about surrounding yourself with smart people. Your social circle can significantly influence your financial success. Remember, achieving wealth isn't about getting lucky or working harder, it's about working smarter. And with these rules from Robert Kiyosaki, you're well on your way to doing just that. Don't forget to subscribe, like, and click the notification bell to not miss any of our upcoming videos.